Hello everyone. On today's class, we're going to talk about one of the key things that is used by traders while analyzing the market and predicting the market direction in the near or short or longer term, and this is trend. Trend is one of the main components of the technical analysis, and it's the most important concept used in predicting market direction. By definition, the trend is the general direction of the financial asset. In this case, we're talking about market, and shows where the market is currently going. But trend could be recognized in many segments of life, not just in trading, in financial markets. For example, we have a trend in fashion when certain clothes, or let's say bags for women, certain brands are very popular in trend as being trendy, so everyone is following. The same rules apply to the trading when the general trend is something that is to be followed, and most of traders try to define the trend and follow it because the trend, going with the trend, gives a sort of security to their investment, and as long as you hold within the main direction, it's a less risk that you may create losses in your trading. So the defining trends and following the trend is one of the key premises in the Forex trading that we'll be talking about this. Of course, this applies to any kind of trading, futures, CFDs, stocks. The principles are always the same. What does it mean? That if the trend is towards the upside, so it's called the uptrend, then the most of traders will be following it. Basically, since the market moves on offer and demand principles, if more traders are following the uptrend and keep buying the asset, financial asset, the price of that asset will go higher, it will continue trending higher, meaning that stronger demand will, of course, push the price higher. And the same principle applies to the opposite direction. If the trend is down, if there is a stronger offer in certain financial instrument, then most of the traders will generate these signals, spot the signals, and follow the signals, which will be defining the downtrend. And of course, a stronger offer will push the price lower. Recently, we have a strong, good sample of this in a steep fall of US WTI crude oil, which is in downtrend. It's been some time, for around 2 months, and there are still no signs of any stronger change in that direction. So this is a type of a strong downtrend in this case. So as the markets move in that direction, traders are trying to join that direction and be more safe with going with the trend. Simple samples could be if the crowd of people is moving in one big street from east towards the west, and one single person is trying to go through them from west towards east, it's very unlikely that that person will succeed, will come, let's say, in one piece at the end, or swimming against the current in the river. If you go with the current, you will go faster and smoother, and you will get less tired, while swimming against the current will basically keep you in one place, and they will be unable to proceed. Similar things are trend in the market trading, when the trend is one of the key points and very important for traders who want to profit at any time. Of course, there are certain steps to be made in order to find this trend, to recognize it, to map it and to follow it, of course. To approach the market analysis from the technical side using technical analysis tools, will need certain of these tools. Let's say trend line is the main thing that is needed. Then as the financial asset continues to move, leaves certain points which could be called supports and resistances. These are the highest or the lowest points when the asset continues to trend, to move in certain direction. So we have supports in this case, or resistances, and we can see it at the moment. We'll see it on the chart to explain how it works. For example, we have a uptrend in this case. We will use the trend line to define that trend. So basically connecting the lowest points. In this case, we have two lows connected. Then the line is called so-called tentative trend line, while more than two points connected will call the trend line a valid trend line. Of course, this one gives us a quite good indication of the uptrend. Now, if we move another parallel trend line on the upper side, we'll create the channel, and in this case, that will be bull channel. And if as long as the price continues to move within that channel, we call it channeling up or down, direction remains unchanged. In this case, this is a trend up. Now, a formation of supports and resistances. We had the first support beginning of the trading, beginning of this trend. Low is at 124.25. Next point, which marks the trough or higher low, is at 124.36. So we have a higher low in this case. First resistance will be this first top that was reached at 126.24, and the price moved in waves. Of course, the market never moves in the straight line, but rather moves in the waves or cycles. So we gather those waves on the bigger picture and define the trend. So we have a first support, a second support, and then we have two resistances. The price is moving. The trend line itself, when it connects certain points, is resistant. There is a strong resistance, and the breach of this trend line will be signal that the trend is either accelerating or changing. In this case, we had the so-called false break above the trend line. There were two attempts, but the price returned back. So it stays within the uptrend, but the strength of the uptrend remains unchanged. While break above the trend line would signal that the trend is accelerating, gaining more and the higher pace. In this case, we have the support and resistance levels. Wherever is the trend line that could be drawn, we can create the thing. So we have the next supports, next resistances patterns. In this case, we have so-called the double top. The price hit twice and was repeatedly rejected at that point. Not necessarily to be exactly the same level, but it's within few pips, so it's a valid pattern. And especially strength of the pattern comes from these two shadows of the daily candlesticks, which show that there was a strong upside rejection, and in both cases, and the market in the reaction to such a pattern moved lower. Then we have moving averages and relative strength index, which are the tools of that technical analysis used in order to help to define the strength of the trend. In this case, it's called the relative strength index, popular RSI, which showed that the trend is in the lower part of the its graph, meaning strongly extended to the downside and has strength, but in this case we call it oversold conditions, and this line needs to be breached to generate this initial signal that this trend might correct before. But still, since we stay within the move under the main bear trend line, the trend is valid and trend is still in play, and upticks could be just used as better opportunities to re-enter the market in the strong downtrend. trading with the trend gives us, as I said at the beginning, more security rather than going against the trend. So imagine if the trader was buying, let's say we had a shorter term uptrend here, and the trader was buying, the strong signal came when the trend of the uptrend was the uptrend breached the trend line. So this is strong signal that something is developing and it may go wrong. So you have to be extremely careful with your existing position. If the position is buying and the general direction of the trend is changing, it's a strong signal that you should consider exiting that position and seeing opportunities to re-enter markets under the new conditions. New conditions mean that the trend is changing. It breached the trend line and turning towards the downside, so becoming a downtrend in this case. These tools, as said, are helping us to map the downtrend. This is one of the key points in trading, and most of those who are educating or advising traders will say map the trend. This is the first thing. Then it will, the next one will be spot that trend and go with it. So basically, while following the trend, it's much safer for you, for trader, rather than going against the trend, as we saw on the chart how dangerous it could be in the sample of US crude oil, which after breaking primary uptrend crashed to the downside and could have caused a lot of losses to the traders who stayed in the long position. So map the trend and follow it, measure the strength of the trend. Also, if the trend lasts for a longer period of time, means that it's tending to continue in that direction until something happens that could distract the trend. Usually these are the corrections, consolidations in the markets, profit taking after a certain longer move in a certain direction, which is a normal, let's call it, procedure in the market. When the traders gather certain amount of profits, they are going out of this position, and taking profit changes the balance between the supply and demand. After, let's say, a long downtrend when everyone was selling, there'll be strong demand for buying to close the positions and take profit. So it may affect the general direction of the instrument. Now the series of, as we said, this is a picture also supporting what we were talking recently. Downtrend, let's say, is defined by series of lower tops and lower lows. We have 1, 2, 3, 4, 5. So a series of these successive lower tops and the lower bottoms, which continue, are defining, in this case, the downtrend. While on the opposite direction, we have an uptrend. The uptrend is also defined by the trend line and the series of successive higher lows and higher highs, in this case called troughs and peaks, mark the uptrend. So first thing is to map the trend and see its direction. Apart from two major trend directions, there is another one which is also in that group. It's called sideways trend. So when you see the price action moving in waves within certain range and is not breaking, and you can connect the tops at the bottoms, so-called floor at the top of that range, this is called directionless or sideways trading or range trading. So basically this is a trend in the flat mode. And most of financial instruments move for quite a long period of time within the directionless mode, and this usually happens after bigger movements in either direction, when the instrument is consolidating after a strong fall or strong acceleration higher. So this is also one of the important points to mention in the classification of the trends. So we have three major directions: up, down, so-called bull trend up, the bear trend down, and sideways trend, or neutral trend, or a flat, which is range trading, which is also part of that group. So this is what we mentioned, major, and this is there is another classification of the trend according to its length. So if we have a major trend which could last longer than a year, this is called a major trend, and we can see the sample right now. A major trend in our sample lasted, we're talking about uptrend, so we will ignore this downtrend. We'll come back to it later. So it lasted from 2016, so we're talking about 2.5 years of the major trend. Now we have a secondary or intermediate trend, which lasts for a couple of weeks to couple of months, and this usually comes after the major trend as corrective or consolidative action, and a short term trend that lasts less than 2-3 weeks. So the major trend is multi-month, longer than a year. Secondary is from a couple of weeks to a couple of months, and less than 2-3 weeks is called short-term or near-term trend. And we'll also see the sample of type of the trends according to their length. So first thing, we have the major trend, which lasted for over 1 year, and it was defined by the trend line. So the instrument, financial instrument in this case, was in strong downtrend. Then we had the secondary trend, which lasted for around 5 weeks. So fits within within this group of secondary or intermediate trends, which need to last at least a couple of weeks to a couple of months. And then we have short-term trend, which lasts 2-3 weeks. This is the one. So we have 3 types of trends according to the length of the trend. Important when mapping the trend is to define the major direction, and usually it's good to start with the larger time frames. So if we take let's say of a monthly chart of US dollar Canadian, we will see the major direction of that currency pair, and we will map that trend, define it by the trend line. So we have the general direction of the US dollar Canadian. We can do it this way also. So we have general direction of the currency pair on the larger time frames, and then we can start narrowing the time frame, because not necessarily that the currency pair will be in the same trend in all time frames. So now we go back to the weekly chart again. Pardon. We still have the uptrend valid after the price moved lower. We have the uptrend that is still going up, and it's called it could be intermediary, because it lasts for about 14 months until now. So the weekly chart shows that trend up is still in play. Now when we go to the daily chart, we have downtrend has been broken. So we have a break of the trend line that showed that defined the previous downtrend, and the price action is now moving in an uptrend. So on the larger time frames, which include daily, weekly, and monthly, we still have an uptrend valid. Going back to the lower time frames, let's say on hourly chart, we can see that things are changing. Currently we are in the sideways mode, which has a great opportunity to be changed to the downtrend, because there are several attempts. We can see here several false breaks below the trend line support. Upside was also limited, so there was no breach to the upside. So it defines the range, and now we have signals of break lower, which could change this existing uptrend even on the lower time frames. On the 4-hour chart is still active, but it tends to change direction after the trend line of sideways mode on hourly chart was breached, and the fresh weakness is basically approaching the trend line support of this leg higher. So we have signals of changing that trend. The same thing could be seen on the crude oil chart, where we have signals of breach of the trend. So the uptrend lasted for over 2 years, 2.5 years approximately. Is going to be one of the longer movements since the crude oil crashed in 2017, hit level of 26.04 US dollars per barrel. It extended its recovery mode, and now the things that change the picture is the break of this trend line. What happens? There were certain other strong factors that influenced dynamics of the movements of the crude oil price, and basically put oil price under increased pressure. If we go to the deeper into the analysis, then we can find out that fundamentals are a main reason of this, as strong supply in oil market pushed the traders out of their long positions and basically turned them into short, as fears that oil market could be easily oversupplied. Global oil market means that the oil price would go under further pressure and could move much lower. So we have a sample here of breaching the trend line which defined the uptrend, and now this is a strong signal, an initial signal for traders that something is developing. There is still not very clear signal. Let's say on the monthly chart, we need to see the end of the month break and close below this trend line to generate more significant reversal signal, as this could be seen also as a correction. So if there is a false break at the trend line, the trend up could continue. But for now, we have a quite strong signal that something is developing. Similar thing is on the weekly chart, and on daily chart now we have a strong downtrend, because the move of past couple of weeks is been shaped in this steep descent on the hourly chart. So we have a quite strong downtrend in US crude oil price, which shows so far no significant signs of losing traction, losing steam, meaning that pressure is still to the downside, and the trend could extend after this corrective action. We can see that corrections were mild. There were 4 or 5 until now. 1, 2, 3, 4. So basically the market, the instrument, financial instrument, any financial instrument needs some time for correction, for consolidation after strong moves in a certain direction. In this case, it was the downtrend. So we can count on some corrective action, but as long as it stays below this trend line, there is no stronger fears that trend could change. If we see a clear break above this trend line, that could give us initial signal that trend, steep downtrend, which lasted for 2.5 months, is changing, and the fall in crude oil prices could turn to the up move of the same instrument. Now again, depending on the strength of the signals, which would directly affect the main drivers of the market, support, supply, and demand. And as we said, we had main instruments, we had the classification of the trends to the major, secondary, and the short term, and then we'll go to trend lines. As we said, we mentioned this already. So the technical tool is used to define the trend. bull trend line connects the lowest points that what we mentioned already, while on the other side, bear trend line connects the series of lower lows and defines the downtrend. And basic definition, the most simple one is that trend lasts as long as that trend line holds. Of course, in both direction. This is the sample what we showed minutes ago with the crude oil. So the trend line is still far away and still keeping the existing downtrend valid. Now, what we were talking about breaching the trend line, we already mentioned this. So when you have the downtrend and probe above the trend line, this could be a good signal that the price is the price direction is changing and the uptrend could be changing to the downtrend. Now we'll go back to our picture with the with the live chart to see how it looks when there is a false break and clear break. First of all, false break could be seen here. So we had one attack to the trend line, another breach which extended a bit above, but did not manage to close that period of time above the trend line and generate stronger signal. And usually false break signals that there will be acceleration in the opposite direction. So the trend remained intact on false break above the trend line. In this case, this is a bear trend, and there is a bear trend line that defines that trend. And now back to our static chart, which shows a clear break above. We had weekly. This is weekly chart. So 2 week, the 3 weeks basically, the instrument is above the trend lines. So there is quite a good signal that something is developing, and the existing trend, in this case downtrend, might change in the short period of time. And this is good for traders to know, as most of the traders were selling in this case, following the downtrend. In case they stay short, they are increasing risk to first of all reduce their existing profits. Secondly, they may go in losses if they continue holding that short position against formation of the uptrend. So trader must be very careful in this case. Now this is something that I would like to highlight. We already went through most of these things, but it's very important to mention the most popular mantra of traders is "trend is your friend." We already said that following the trend increases your opportunities to make profit while trading certain financial instrument, while of course going against trend sees increased risk of creating losses and having a negative balance at the end. So trend is your friend is something that is very popular, and most of traders follow this. We go back to the supply and demand. When the most of traders follow certain trend, mean that they are increasing supply or demand in this case, and generating stronger signals for that trend, forming basically the trend. If you are going against the trend, that could be quite risky. Such traders were called contrarians, and according to my personal experience, I've seen many of them losing money. Of course, experienced traders will use any opportunity to make money, and they will jump into the so-called subtrends. So if we have the general trend to the downside, traders will be looking for any correction, any move to generate profits. So in this case, if we have trend the lower, according to the main theory that what we talked about today, so stay short. If you are selling, keep this position. Traders, experienced traders, professional traders will go, let's say, short here, then they will wait for signal to jump into the long position for some time, but will be very careful with the trend line, and they will have a strong signal here that trend line has rejected the upside attack, so signal to exit that quick long position, and then they will again jump into the shorts because general trend is down. In case they go long above the they go long and stay long if the instrument does not break the trend line, that could be quite risky. I've seen a good sample was after the Brexit vote, when many traders, actually majority, were short crude oil after decision was made to exit that UK will exit the European Union, and most of traders were short, but I've seen a number of traders who were long crude oil at that time, which I didn't see something very appropriate. I'm trying just to find that move in 2016, if we are at the right chart. So basically, most of traders have lost their funds by entering a market in the wrong direction, which could be quite dangerous if you are trying to fight against trend. Bear in your mind that there are very big traders in the market carrying enormous amounts of money, and basically the small retail traders are going against them. It's very unlikely that they will succeed in such attempts. So the best thing is to stay with the trend and stay with the main direction that will give a sort of safety to the trader, and of course follow the main rules. So if the trend is your friend, stay with your friend. Very dangerous thing is to go against the trend. As we said, following a trend reduces risk to the investment. So if you are with the trend, then you have a much greater opportunity to come out with the profit, while being contrarian. And being contrarian in the major change of the trend, when, let's say, a downtrend changes to the uptrend and you stay short, that is quite risky to your investment. So it's quite good advice for any who want to enter market to first map the trend and follow it, because if you go against the trend, that's a quite risky thing.